So good day, everyone, and welcome to today's section. And what we are going to talk about today is the principle and practice of double entry. We're going to be talking about principle and practice of double entry. And if you remember in our previous section, we talk about the general overview of accounting. In terms of what are some of the things that we are going to be talking about in this syllabus? And one of the principles that I made mention earlier during the previous section was that we have a principle in accounting called principle of double entry. And what does this principle mean? It simply means that for every debit, there must be a credit, and vice versa. For every debit, there must be a credit, and vice versa. So meaning that if you have a debit somewhere, you must also have a credit. In accounting, every accounting transaction involves twofold. Every accounting transaction involves twofold, meaning that we have a debit somewhere, and we also have a credit somewhere. If you receive a certain amount of receive a certain amount of inflow in your bank account now, then you are being credited, right? Then there's another ledger that is also being debited. So every transaction will have this twofold. There will be debit, and there will also be There will also be credit. And this is what we are saying. If I debit one account, this is debit, and this is credit. If I debit one account, we are also going to credit another We are also going to credit another account. That is the duality concept. Meaning that for every debit, there must also be a credit. So what we are now going to be doing in today's section is that, okay, let's say this is Mr. B. Then I also need to have now? Let's say I have now? Debit. I also need to have credit. This is another account. Then I also need to have Mr. Let's say Mr. C. So if I debit this particular account with 1,000 naira, I must also credit this particular account with 1,000 naira. So there must be a corresponding amount. There must be a corresponding There must be a corresponding amount. That is what the principle is saying. For every debit, there must be a credit. And sometime, maybe I want to now? Let's say, for example, this is Mr. A. Let me still maintain Mr. B. This is Mr. B. Debit, and this credit. I debited Mr. A with 1,000 naira. Now, I can now have now? Debit. I can have credit as well of Mr. Let's say A. I can also have another account now. Credit and debit. This is Mr. C. I can credit this with 600. I can also credit this with with 400. So you can see now, at the end of the day, you are having 1,000 here on the debit. You have 600 here. You also have 400. So when we add everything up now, you can see we are going to have that we are going to have 1,000. So sometimes it does not necessarily that it has to be oh, you debit this account with 1,000 naira. The next account, you must also debit it to 1,000 naira. There are some times that there may be a split. But the goal is that if there's a debit on the debit, If I had all the credit, it must also be what? It must also be equal with what we have on the debit. Oh, there's 600 here. There's 400 here. If we had all this together now, we're having 1,000 naira. It must also correspond with what we have on the debit. That is what the principle is what it's saying. Please don't forget. For every debit, there must be what? There must be a credit. If you debit one account, you must also what? You must also credit another account. And please, everything that we're going to be doing maybe from now on is going to be, they are principle based. We are going to be talking about principle. Because in accounting, there are some topics that are very, very simple. There are some topics that are very, very simple. What you just need to try as much as possible to do is understand the concept, understand the principle. And there are some that if you really want to learn it very well, you need to first of all understand the format in terms of the layout. How am I going to present this? There are some topics like that. If you understand the format very well, it will really go a long way. And what we are doing from now on is not really it's not format based, but it is what? It is principle based. It is principle based. So please, you need to understand this very well. And what we are still going to be talking about is what? Is debit this account, credit this account. So that is what the principle of double entry is saying. For every debit, there must be what? There must be a credit. So let me now let's now go now. Let's now talk about the application of this principle. Application of the principle of double entry. We have one. And the first one I want to make mention of is that any transaction involve two accounts. Every transaction involve two accounts. Every transaction involves two accounts. Let's say A now. Please hold on. There's a receiving account and B, there's a giving account. Or sometimes we call this the receiver. Why this is the giver. Please now, everybody, don't forget this. And these are the various steps that we need to have at the back of our mind whenever we are doing this. Every transaction will have two. And that's why I'm using it earlier as well. That if you make a certain payment to someone now, it is just one transaction. But there are two accounts that is involved. Oh, you send a boy, you make a certain payment to someone. It's one transaction. Let's say, for example, now, purchase of what? Purchase of AC. That is one transaction. AC is what? Is one. So there are two accounts that is involved. There's someone that is receiving the payment, and there's someone that is sending the money. That is one. So the number two now Number 2 now. Is that one account that is the second thing. One account will be what? It will be debited. And another one will be what? It will be credited. So the next thing that we now need to talk about now, we say one account will be what? It will be debited. And another one will be what? Another one will be credited. One account will be what? It will be debited. Another one will be what? It will be credited. So let me now explain something. I will now say what now? Number 3. Please don't worry. The work file will be shared at the end of this class. Element of financial statements. If you remember in the word in our first class, and I will continue to be saying this in the majority of our classes, that we have 5 elements of financial statement. We have what? 5 elements of what? Of financial statement. And I think I use MTN annual report now during our last class to give that word, to give that example. So let me also do what now. I can also open that back now. So meaning that what now? In accounting, if you see a word, a financial statement now, a financial statement, every transaction in accounting, let me even not go far, every word, every transaction in accounting, every item that we can see in our what? In our financial statement is divided into what? Is divided into 5. Please don't forget. Every transaction is divided into what? Is divided into 5. Is divided into 5. And I use MTM as an example during our previous class. This is a what now? This is a financial statement. This is a what? This is a financial statement. This is a financial statement of MTN Nigeria as at 31st of December 2022. So this is your financial statement. So every item that you can see in this financial statement now, starting from the word, the first one is what? Statement of profit or loss. The second one is what? Other comprehensive income. The statement of other comprehensive. Now we have the word, the second one now to be statement of financial position. The third one to be what? Statement of changes in equity. Then the number 4 is what we call a statement of cash flow. And the last one is what we call the word, the note to the account. This is the 5th one. So from this number 1 to 4, every item that you can find in this word, in this financial statement, is basically divided into what? Into 5. Now, There's asset. There's liability. There's equity. There's income. And we also have what? Expenses. So please don't forget, every accounting transaction is not more than this 5. Every transaction in accounting is divided into this 5. So let me now say what increase. And let me say what decrease. You know, the first step that we say is what? The application. Any transaction involve how many accounts? It involves 2 accounts. There's one that is receiving and there's one that is giving. One account will be debited, another account will be what? It will be credited. So if you now want to know, how will you know that? You know, we are talking about 2 things now. We say one will be debited, another one will be what? It will be credited. That one is easy to what? It's easy to learn. It's easy to what? It's easy to learn because you know already now that if you transfer a certain amount from your bank account now to another individual, you are going to be debited, while the word individual that is receiving it, it will be what? It will be credited, right? So once you know that one now, that one is generic. It's not bad. It's easy to learn. The next thing now is that, okay, and this is the step 3. This one is very, very crucial. How will you know that, oh, it is this account I'm going to debit? How will you know that it is this account I'm going to credit? The simple way to do that is just by looking at categorizing the transaction into these elements. That is it asset? Is it liability? Is it equity? Is it income? Sorry. So that is the word, that is the first thing that we have to try as much as possible to understand. The first thing is that what every transaction is basically into what? Is basically into 5. If you look at the word now, if you look at the typically word financial statement now, every item that you can see in this financial statement now is basically divided into what? Into 5. Any transaction that you as an individual now, as an organization now that you enter into, we can basically what? Classify it into what? Into 5. And that's what we call in accounting element of what? Of financial statement. So there are 5 elements of financial statement. There's asset, there's liability, there's equity, there's income, and there's also what? There's also expenses. So if you discover that asset account is increasing, maybe asset account is the what now? Is the receiver. You're going to debit. When I say increase here, let me still maintain the word I'm using before. If I say increase, let's say is the word is the receiver. And if I say decrease, let's say is the word is the giver. So if your asset account is increasing, you are going to do what? You are going to debit. And if it is reducing, if it is a giver, you do what? You credit. If your liability is increasing, it's credit. Equity increasing is credit. Income is increasing is credit. And expenses is increasing is debit. Then this would be what? Debit then. It will be debit. It will be debit. It will be what? It will be correct. And you see, accounting is very easy to practice. It is even very easy to learn. Because majority of the things that we're talking about in accounting, there's already a regulation for it. There's already a regulation already. That, oh, if this particular transaction occur, this is how you're going to do it. If this one occur, this is how you're going to do it. So the key things that we just need to try as much as possible is understand the concept, understand the principle. That what is this principle saying? That is the key thing. The regulation is already there. The standard is there already. And that's why sometimes if you practice, or maybe you didn't remember what this particular standard is saying, oh, you can easily ask your colleague that, oh, what is this particular accounting standard saying on this? Because it is one. So if you can't remember, another individual will remember because it is one standard. So please don't forget this. So assuming that asset account is receiving, is the one that is receiving, you do what? You debit. Oh, let's say expenses is the one that is receiving, you do what? You debit as well. So please don't forget, you can see expenses and assets, they have the same treatment. The way you are going to treat your asset is still the same way you are going to treat your liability. Your expenses. The way you are going to treat your assets is still the same way you treat your expenses. So asset and expenses have the same treatment. Liability, equity, and income also have the same treatment. Okay? So that's just it. And that's a 3-step that I would also like you to have at the back of your mind. That the number one is that what? Any transaction involves 2 accounts. There'll be one there'll be the receiver, and there'll be one that will be the giver. The next thing is that what one account needs to debit, another one needs to be credit. So how do you not know that, oh, this is the one I'm going to debit, this is the one that I'm going to credit? If it is asset. If it is receiving, if it is increasing, you are going to debit. And vice versa. If it is reducing or if it is the giver, you are going to do what? You are going to credit. So in end product, asset and expenses have the same treatment. Liability, equity, and income also have the same word, also have the same treatment. So that is it. Then another thing that I would also like to explain, another thing that I also need to explain now is, let's talk about what? Let's talk about when we say account. Sorry. When we say account, what are we referring to? When we say account, what are we referring to? And when we say account is different from accounting. So when we say accounts, this is the definition of account. Account is defined as a statement So that's some meaning of accounts. It's defined as a statement in which a double entry system, defined as a statement in the double entry system, in which transactions are recorded in a specific class, which have taken place during a period. Now, I also want you to please, when we talk about accounts, we also have something called classification of accounts. Classification of account. One, we have what we call, and there are two, there's what we call personal. And there's also what we call what? Impersonal. So when we say impersonal, impersonal is divided into two. There's what we call real accounts. And there's also what we call a nominal accounts. So that those are the two classification of accounts. So when we say nominal account, what are we referring to? Sorry, when we say personal account, what are we referring to? When we say impersonal account, what are we referring to? And when we say personal account, individuals, they deal with what? Corporate entity. So that's what we call personal account. From the word personal, they deal with what? Individuals, they deal with entity that we have transacted business with. That's what we call personal account. From the word personal, is between individuals, it's between what? Entity. Now, when we now say the second one, which is what? Impersonal account. Impersonal account deal with what? Three things. Impersonal account deal with how many things? It deal with three things. Please don't forget. Impersonal account deal with what? Impersonal account deal with what? Three things. deal with income. And this personal account sorry. So that's it. Now, personal account deal with what? It deal with liability. It also what is access is also involved. So these are basic two things that personal account deal with: liability and what an asset. Liability and what? Liability and asset. So when we now say what now? When we now say in personal account, in personal account deal with what? It deal with assets, it deal with what? Income, and it also deal with what? Expenses. So, but if you remember, we make mention that in personal account is divided into two. Real account. So when we say real account deal with what? Assets only. Real account deal with what? Assets only. While nominal account deal with what? Income and expenses. Please don't forget that. Real account deal with what? Real account deal with assets. Nominal account deal with what? Income and expenses. Personal account deal with what? Assets and liability. And when we say nominal account are just accounts in which income and expenses are recorded. Nominal account are those accounts in which asset and liability are what? Are recorded. While real accounts are those accounts in which what? A non-current asset. Let me put it this way. Non-current asset. In the olden day in accounting, some of us, maybe you have a knowledge of it before. We used to call it what? Fixed asset. So we don't call it what? Fixed asset anymore. We call it what? Not the new name now is what we call what? Non-current assets. So real account deal with what? Non-current assets. Real account deal with what? Non-current assets. Real account deal with what? Non-current assets. But nominal account deal with what? Income and what? Income and expenses. And for personal accounts, the account that personal account deal with are what? Current assets, because there's also assets here. But the asset that we are referring to here is what? Is current what? Is current asset. So this here is what is current asset. Because in a typically financial statement, just like you can see, let me go to the statement of financial position. You can see now the heading is what? Assets. But in this asset now, how many sections do we have? You can see we have non-current assets, and we also have a current asset. Before we now have the total asset now. So this total asset now comprises of two things. It's comprised of current, and it's also comprised of what? Non-current. In the olden day, or some of us, we can still rehand the terms. They can be calling it what? Fixed assets. But we don't call it fixed asset anymore. The name has what? The name has changed in accounting. It is now called what? Non-current assets. But the name for current assets still remain the same thing. The only thing that changed here is this name. In the olden day, it was called what? Fixed assets. But now the new name is what we call what? Non-current asset. Okay, so that is it. So that is that. We have two types of account, classification of account. There's personal account, and there's also what? Impersonal account. Impersonal account is divided into what? Is divided. We have nominal, and we also have what we call what? Real. Nominal and what? And real account. Okay, real account only deal with what? Assets alone, non-current assets, whether tangible or what? Or intangible. But nominal accounts is just account that we use to record income and what? Income and expenses. Okay, so that's just it. Now let me now tell you something. Please hold on. Okay, so let's go. I have account now. Just a diagram. We have accounts. We have what now? Personal. We have personal accounts. And we also have what we call what? Impersonal words. We also have what we call impersonal accounts. So for the personal account, let me say, for example, receivable. Let's say receivable and payable. When we say receivable, that's a new name for what? For debtors. We don't call it debtors anymore in accounting. We call it what? Receivable. Why payable is the new name for what? For creditors. I don't know, maybe some of us have accounting knowledge before. When we say creditor in accounting now, we don't call it creditor anymore. The new name now is what? Is payable. Debtors now, we don't call it debtors anymore. We call it what? Receivable. So why this? This can be what? A nominal. And we can also have what? Real. So example might be expenses. It might be gain. Maybe losses. It can also be a word, and it can also be income. So for this, it can be what? Let's say motor vehicle as an example. You have what? Furniture. Let's say our delivery van. You can have some equipment. So those are let me stop there. No, let me not give you the rule. So and please don't forget this. This is very, very important. And please don't forget that. And that is the end product result of what we have been talking about for quite numbers of time now. If it is a personal account, debit the what? The receiver and credit the giver. If it is a real account, debit what comes in and credit what goes out. If it is a nominal account, debit what comes in, debit the expenses and the losses, and credit the what? The income or the what? Or the gain. So please don't forget this. Now, once we understand this, we can answer a question now. And I just have a simple question that we are going to do. But before then, let's take some time now and look at what we have talked about so far. And let me explain it again. We started with what? Explaining the concept of what? Of double entry. The concept of double entry. And what double entry is just simply saying is that once there is debit, there will be what? There will be a credit. And if you look at this, let me say this is number one. I say Mr. A, debit Mr. B with 1,000 and credit Mr. C. It's also what? 1,000. That is what the rule is saying. Now for every debit, there must be a what? There must be a credit. And I also draw another ledger. When we say a ledger, this is a ledger, is in form of T. There'll be one fold for debit, there'll be another fold for what? For credit. So I say Mr. B, debit Mr. B with 1,000. Credit Mr. A with what? 600. And credit Mr. C with what? With 400. So you can see now, when we had the debit and the credit together, they are what? They are the same. 600 plus 400 is 1,000 on the credit side. So it's equal to what we have on the what? It's equal to what we have on the debit side as well. Then we move on by explaining that what's the application of double entry system. Any transaction involves two accounts. That's the first thing. One transaction involves how many accounts? It involves two accounts. There will be one account that will be the debit, There's also going to be another account that will be the what, that will be the credit. So one account will be debited and another one will be what, it will be credited. So you need to know which account are you going to debit, which one are you going to what, are you going to credit? That's the third step, and that's what we call the what, the element of what, of financial statement. In accounting, every transaction can be categorized into 5. Any transaction, it can be categorized into this 5. There's the asset section, there's the liability, there's equity, there's income, and there's expenses. So increase and there's decrease. If your asset is increasing, it's debit. And please don't forget this thing. It is very, very, very important. It's very, very well. It's very, very important. Please don't forget that. Okay. So asset now, you are going to do what? For assets, increase debit, decrease credit. And once you know assets, you know expenses as well. Because asset and expenses have the same treatment. The way you're going to treat your asset is also going to be the same way you treat your expense. Asset and expense have the same treatment. Liability, equity, and income also have the same treatment. The way you're going to treat your liability is the same way you treat your equity, is the same way you treat your income. Then we move on to talk about account. We talk about classification of accounts. Account is basically classified into 2. There's personal and there's also what, impersonal account. Personal account are just account of individuals, business entity that we transact with. Then impersonal account is further divided into 2. Nominal and what, and real account. Impersonal account deal with asset, deal with income, and is also deal with expenses. And real account only deal with what, assets. And the asset that we're talking about is what, is non-current assets. Non-current asset, meaning that what, asset that will last for a what, that will last for more than one accounting period. Then we have the what, the nominal account. The nominal account is for income and what, and expenses. Then we have something like this. There's personal, and there's also what's in personal, which I gave the word, the example of each. Okay. So, what is the rule here? For personal, debit, credit the giver. For real, debit what is coming in, credit what is going out. For nominal, debit the expenses or the losses, credit the what, the income or the gain. So that is it. Now let's we can now practicalize what we have learned using this simple question here. Now we have a question here called what? Bravo Words Enterprise. Bravo Words Enterprise. And they say Bravo Enterprise started business. And what's the requirement? The requirement is that we should prepare a ledger. And when we say a ledger, this is a word, this is a ledger. Debit, credit, your unit of measurement. So this is a ledger. A ledger will have these words. A ledger will have this code. There will be a debit, and there will be a word, and there will be a credit. So every transaction now, we'll post it into what? We are going to post it into a ledger. We are going to post it into a what? Into a ledger. So this is how it works. This is how a ledger looks like. And once we have a ledger, then we can now extract our trial balance. Once we have a ledger, we can extract what? We can extract our trial balance. which we are still going to what we are still going to do as well. And when we say a ledger, what is even a what a ledger? Let's talk about this is a ledger. So when we say a ledger, what does a ledger mean? And let me explain that as well, because we are going to be making use of it now. When we say a ledger, what is a ledger? And when we say a ledger is simply defined as a principal book of accounts that accommodate what permanent record of transaction. Let me put something down so that you can. When we say a ledger, sometimes we call it the principal book. In a classified and summarized form. So that's what we call a ledger. It's a principal book that contains what? That contains permanent record of what of transaction of the business. So when we now say a ledger also has some classification. Classification of ledger. And basically, there are three. One, we have what we call what? Personal ledger. Personal what? Personal ledger. And this particular account comprises of suppliers accounts and it also comprises of what? Customers accounts. Personal ledger contain what? Contain information of your what? Your suppliers and your customers. Contain information of your what? Of your suppliers and what? Customer. And that's why sometimes we used to say that what? Types of personal ledger. So mean that what? I can also say types of what? Type of personal ledger. Types of what? Personal ledger. There's one called sales ledger. And there's another one called what? There's another one called purchase what? Purchase ledger. That is one. So personal ledger contain what? It contains information relating to your what? Your sales. And when we say sales now, it simply means that we are talking about what? Customer. This one refers to what? This one refers to what? To suppliers. So that's it. Then we also have another one called what? General ledger. Ledger is basically divided into three. There's personal, there's general ledger, and there's also what we call private ledger. So this is another one now. Is that done? Sorry. And when we say general ledger contains information of two things. It contains information of one. It contains information of what? Information of what, please? It contains information of what? The real account. And it also contains information of what? Nominal accounts. And number three, which is the last one, is what we call private ledger. Private ledger contain information, could I say contain accounting information relating to the owner of the business. For example, drawing accounts. You can have what? Capital accounts. So those are so these are what we call a ledger. A ledger is a what? A ledger is a principal book of accounts that contain permanent record of what? Of transaction of a business in a classified and summarized form. And this is a ledger. This is a personal. Debit, credit, naira. Then you can say what? In your that account. This is how a ledger look like. Okay, that's how a ledger look like. Now, let me now say something now. The double entry word, the double entry practice. And this is the last now. Why we go to it was why we solve a question. Like I made mention earlier, Every transaction will have two accounts. Every word, every transaction must have two accounts. Must affect two accounts. You know that already. One single transaction, it will have what? It will have two accounts. The next one is that give a name. So the two accounts. So this is the principle that we are going to follow now. You know already that every transaction will have two accounts that will be affected, right? That's the first thing. The second thing, okay, once you know that there will be two accounts, give it a name. What name are you going to call it? Then the next thing you what? Do your debit and what? Do your debit and credit. Do your debit and what? Do your debit and credit. So this is the what? This is the explanation of what we are going to do now. Please have a look at this thing again. I'm not in a hurry. So transaction that we are going to be will be coming across now. We'll enter into a what? We'll enter into a ledger. We'll enter into a what? Into a ledger. So one transaction, it will have two accounts that will be affected. So the two accounts, we are going to give it a name. Whether it's going to be a what? Sales account, whether it's going to be a what? Sales account and bank account, whether purchase account and what? And bank account. So you are going to give it a name. So I think that is it. So let's go now. So the requirement is the words prepare a ledger account for Bravo Enterprise and bring down the words, bring down the balance. So this is it. Please, before we start now, I would like everybody to please just read through words, read through discussion. Just read through it. Okay, just give me some few minutes, please. Just read through. From January 4, there's 6, there's 7, there's 9, there's 11. Just read through. Thanks. So let's go now. Bravo Enterprise started a business on January 3rd with 20 million cash from his personal wealth savings. The following transaction took place in the month of January. So these are the transactions that took place in the month of January. These are the transactions that took place in the month of January. So now, he started a business with what? He started a business with 20 million cash from his personal savings. So we are going to record that as well. And we are going to record that in a private ledger called capital accounts. This Bravo is the word, I think that's the name of the sole proprietor. He started his business on January 3rd and it bring him 20 million from his cash up. So we are going to record that now. We are going to open a ledger for it. And the ledger that we are going to open for it now is what we call capital account. So the first thing that you're going to do, is that, okay, this is a 20 million now, is a transaction. And we have it at the back of our mind now that there will be two accounts that will be affected. There's going to be a two account that will be affected from one single transaction. So here now, the transaction, there are two ledgers, right? There are two accounts that will be affected. There's going to be debit one and there's going to be a credit one. You know that already. The second thing that I make mention here is that give it a name. Give the name to the two accounts. You have to give it a name. You know already that every transaction must have two accounts, right? Okay, Bravo is the owner of the business now. He introduced a cash of what now? Of 20 million from his personal savings. From his personal savings. So, and in accounting, we have a concept called entity concept. We have a concept called entity concept. What entity concept is saying, after the end of this class, and I'm going to send the note on accounting concept and convention, the practice question, and the work file that we're using. So just pay attention to me. Every necessary material will be sent to you. Now, the entity concept is saying that the owner of the business is different from the business himself. Bravo is different from Bravo Enterprise. Bravo is different from what? Bravo Enterprise. So we are going to treat the two separate. We are going to treat the owner separate, and we are also going to treat the business also. We are also going to treat the business separate as well. That is what the entity that's what the entity concept is what it's saying. The owner of the business is different from the business themselves. So we know that there's 20 million that is coming in now. The next thing that we need to do is that, okay, which two accounts will be what? Which two accounts will be affected? Which two accounts will be what? Will be affected? The account that will be affected now are what? Capital account and what? And cash account. Or maybe bank account. Because you can't have a cash of what? Okay, they say cash, right? But we just need to follow it the way it is. So the account that will be affected now is the capital account and the what? And the cash account. The capital account and the what? And the cash account. So we are now going to do what now? We are going to open a ledger. This is how a ledger look like. So I have my what now? Capital account. There's credit and there's debit. And let me be writing it, for example. In the exam, you don't need to be doing this. Capital accounts is an equity account. Capital account is a word, is an equity account. So if equity account is increasing, if equity account is increasing, is what? Is credit. If equity account is increasing, is what? Is credit. So we are going to say what now? Cash of 20 million. So that is all. The next thing is for every debit, there must be a credit. For every debit, there must be a credit. So I need to open a what now? A cash account. Credit and debit. And sorry, what's going on? There's going to be a lot of transaction that will be in this cash account. Please hold on. Sorry. So let's go. So I have my what now? My cash account. So here, and I can cap it in thousand. I can also cap here in what? In thousand. So I'll say what now? Capital of what now? Of 20,000 naira. So you can see now we have maintained the principle. There should be debit somewhere, and there should be what? There should be credit as well. So I have credited capital account and cash account. Cash is a word. This is an asset account. And if asset is increasing, is what? Is debit. If asset is increasing, is what? Is debit. If asset is increasing, is what? Is debit. So I have debited that now. If equity is increasing, is what? Is credit. You can have it. You can see it here. If asset account is increasing, is what? If asset is increasing, is debit. If equity is increasing, is what? Is credit. So you can say, what? Please don't forget, try as much as possible to understand these three. Asset, liability, and don't forget, it's very easy to learn. Just know that asset and expenses have the same treatment. Liability, equity, and income also have the same treatment. Okay? So that is a guide. If asset is increasing, you put it on the what? On the debit. So let's go. So that's all. We'll move on to the next one. Let's say on January 4 now, paid 80 million into the bank account. So you know that the money came in as what? As cash. The money came in as what? As cash. So we now need to have another account now called what? Bank account. So let me now have a bank account here now. Once you don't have the ledger in existence, you are going to create a new ledger. You are going to create a what? A new ledger. So I don't have bank account ledger before. So that's why I'm bringing up a what? A new one now. But if the ledger is already in existence, you're not going to create a new one again. Like for example now, this transaction of what? 80 million now, it relates with bank and cash. Because you are taking the money from cash, you are not taking it to what? To bank. You are taking the money from what? From cash and taking it to what? To bank. So I have two ledger that is affected by this transaction is cash account and what? Bank account. Cash, you have a cash with you now of 20 million. You now take what now? 18 million out of it to the bank. So you can see now that your cash is reducing, right? Your cash is what now? Your cash is reducing while your bank account is receiving. So we have cash ledger already. This is a cash ledger. So I don't need to open another one again since it is already in existence. So since you have 20 million in your bank on your cash before, and you are not taking 18 out now, that means that this your cash now is an asset that it is reducing. So we are going to say what now? Bank 18. Because it's reducing, we will not take it to the what? We take it to the bank account. Then you say what now? It's coming from which ledger? It's coming from cash. Then you say what's 18. That is the principle. That is the word. That's the word. That's the principle. That is the principle. That is the principle. Please, in case you have any question, please, you can raise up your hand or put it in the chat box. Please do ask the question if you have any. There's already a cash account already. So that's why we are not bringing up a new one. You have a cash with you of 20,000, let's say, for example, and you are taking 18 to bank. So I'm going to credit your cash now because cash is an asset and it is reducing. If your cash is reducing, which is an asset, you do what? You credit. So I'm crediting this account now with 18. Then bank is receiving. Bank is what now? Bank is receiving. So that's why we are doing what now? Bank is receiving and we are doing what now? We are debiting what now? We are debiting cash account. So that's just it. That's all about what? That's all about that particular transaction. There's also another transaction on what? On the same date, which is this. Let's say bought office building, paying check by what? By 4 million. Bought office what? Bought office building, paying by what? Paying by check. You bought office building, paying by what? Paying by check. So once you hear check now, it's already signified that it is relating to the what? To the bank. So I have a bank ledger before. This is the ledger for the bank. So this particular transaction now that you bought what? Office furniture for how much now? You bought office furniture for, I think, 4 million. Is each of those accounts a ledger account? Yeah. Each of these heading and bank account, this is a ledger. This is also a what now? A cash account. I have 3 ledger now. I have capital, I have cash, and I also have bank. So they are what now? They are a ledger account. Once you just see anything in T format, there's one side for debit, there's another one for credit. It signifies what? Ledger. So you bought office building, paying by check. You bought office building, paying by what? Bought office building, paying by check. Office building need to have a ledger on its own. It's a separate asset. Motor vehicle is an asset. Furniture and fitting is an asset. Your computer, your laptop that you're using now is an asset. But they are not the same because we have different types of assets. So we need to do what now? We need to segregate it. We need to segregate. You can't say that, oh, you have a ledger now and you call it what? Asset account. Oh, no, it's not like that. Each asset is what? Is different. So you are going to create a what? You are going to create a ledger for each of them separately once they are not the same. Motor vehicle is an asset. Office building is an asset. The AC is an asset. The computer equipment that we're using in office is an asset. Printer is an asset. So each of them are not the same. So if they are not the same, you are not going to merge it together. You are going to do what? You separate it. So I have now? I have office building. And we don't have office building before. So we need to create another ledger now for what? For office building. We need to create another ledger now for office building. I still want this one to be a little bit long. Let me find this way. So let me have what now? Office building. Office building accounts. Our credits and our debits. So this is a ledger now. If there's another transaction that is relating to office building again, I will not create a new ledger again because I already have a word office building. So this office building is what? Office building is an asset. So this is an asset and is receiving, let's say bank. So I'll say what now? Bank. We paid for it. We say bank. Then I'll say what now? Office what? Office building. 8,000. So you can see now, for every debit, there must be a what? There must be credit. For every debit, there must be a what? There must be a credit. Please hold on, sorry. Give me some few seconds. Let me plug my system. So let's continue. So we are through with that word. We are through with that particular word. We are through with that particular transaction. The next one, January 6th, bought delivery van of 3 million from Amaco, paying by check. So delivery van is also what? An asset, but it's different from what? Office building. So I don't have what? Delivery van before. So I'll create another what now? Another ledger for what? Another ledger for delivery van. Delivery van accounts. So credits and my what? And my debits. Because we don't have any ledger before relating to what? Delivery van. So that is it. So how much was the payment? The payment is 3 million by check, Abby. So we say what now? Bank. Three. Then I'll go to bank account to say what now? Delivery van. So that's it. Then that is all about what? That is all about this now. Now, the next one This, I think this class is supposed to be 2 hours and it's going to end in, okay, this 11:05. So it's just, maybe I need to take like 10 minutes of your time. So I'm just saying that in advance, but if I can finish it in 25 minutes time, that'll be fine. Now, the next one is what, that's on the 7 now. Let's say purchase goods worth 2 million, paying by check. Purchase goods worth 2 million, paying by check. Once you get check, it means it's what now? It's bank. Once you get check, it's relating to what? It's relating to bank. So we purchase goods now. So of 2 million, that is one transaction. So this transaction now will have twofold. There will be there will be 2 ledgers that will be affected. There's going to be a purchase account, and there's also going to be a bank account to be affected. Don't forget, one single transaction, how many ledgers will be affected? A minimum of 2 ledgers will be affected. A minimum of what? Of 2 ledgers will be affected. Okay, wouldn't be ample ledger. No, from this is what the guy that we are buying it from. But we are paid, so there's no any problem. Since we are paid by check, we are not going to create what ample ledger. Assuming that we have not paid, that's now when we can create that particular ledger for an amount. But we are paid. We are still going to see opposite of it. The next one is what? Purchase goods worth 2 million. So I'm going to have a what now? A purchase account. We don't have purchase account before. We don't have a purchase account before. So let me use this phrase. I have in my what now? My purchase. Sorry. Okay. So we have this. So bank of 2 million. So we have a purchase account now, and we have paid, we purchase. And we have paid. So I'll go to my bank account now. I'll go to my bank account and say what now? Purchase. This is an asset account. In the exam, there's no need of you writing this. This is just for class purpose. So if you have 18 million in your bank account now, you are not spending. You are paying for delivery van, you are paying for building, you are paying for purchase. You'll be doing the what? You'll be doing the credits. You'll be doing the what? You'll be doing the credits. Then on the 9 now, let's say a cash sales of 2 million. Cash sales of what? Of 2 million. So who can try now? Which account is going to be affected now from this number 9, January 9? A cash sales of what? Of 2 million. Which account is it going to be affected? Okay. Someone is confused about this 6. Now, they say you bought delivery van. Let's say you bought delivery van from what? Inosu now. And you have paid Inosu. So we don't need to record what now on Inosu again, since we are paid. So that's why with the accounting entry that we just need to do for this January 6 is just for us to debit delivery van and credit our bank because we have paid. So this particular vendor that we are buying it from, we are not going to record, it's not going to appear in our ledger at all because we have paid. So we don't have anything to do with that. Assuming that we have not paid now, well, that's now when we can have what? This particular vendor name. But we have paid this particular vendor now, so we don't need to have a name for it in our ledger. The ledger that is affected for this sales is just our what? Delivery van, which is an asset, what we are buying. And how do we pay? We pay through the bank. So we credit our bank and we debit the asset that we are buying. So the vendor that we are buying it from is not going to appear in our account because we are bought, we are paid. We are still going to see, we are going to come across another one now, that we bought something from someone, but you have not paid. We'll get to that as well. Is here. So we have a word now on 9. Let's say a cash sales. A cash sales of how much? A cash sales of 2 million. And we have it in the word in the chat box already. That I asked that which account will be affected. It will be cash account. Okay, that's one. What about the second account that will be affected? What about the second account that will be affected? So that is one. There's always going to be 2. There's cash account now because we are selling and we are receiving the payments. So I will go to my now? To my cash account and say what now? That would be what? Sales account. Of what? Of 2 million. Then we are not going to have another account called what? Sales account. But we don't call it sales account anymore. The new name that we call it now is what? Is revenue. We call it what? Revenue. We don't call it sales anymore. We call it what? Revenue account. We don't call it sales account anymore. Please don't forget that. The new name is what? Is revenue account. And this is an what? Is an income account. Then what is an income what? Income account. So once you are selling, whether it's a credit sales or whether it's a cash sales, sales account will always be credited. It is always going to be what? It is always going to be credited once it is what? It is sales. Whether it is a credit sales, whether the customer is paying at the spot or is not paying at the spot, this particular account will always be credited once you are making sales. Once you are making sales, this particular account will always be credited, whether the customer is paying as at now or is going to pay in the future. Sales account is always going to be credited for that, whether it's a cash sales or it's a credit sales, because sales can be of 2 forms. Sales can be of how many forms? Sales can be of 2 forms. There's cash sales and there's a cash purchase. So whether it's a cash sales, whether it's a credit sales, sales account will always be what? Will always be credited. So, and that's all. I have credited my sales account and I have debited the what? I have debited the cash account because we are receiving the money. So this is gone. The next one, then I say what? Sold goods to what? Sold goods on credit to buyer. You sold goods on credit to what? To buyer. Worth 1.5 million. If you remember what I just make mention now, whether it is a cash sales or whether it's a credit sales, sales account will always be credited. So you sold goods to what? To buyer now of 1.5 million is on credit. So I'll say what now? Buyer. Then 1.5 million. Buyer has not paid. Whether it is a cash sales or a credit sales account will always be credited. So buyer has not paid now. I'm now going to create a ledger for buyer. I'm going to create a ledger for what? For buyer. And this is what we call what? This is a receivable. This is what we call trade what? Trade receivable. In the olden day, buyer is owing us now. Buyer is doing what? Buyer is owing the what? The entity. Buyer is owing us. Buyer is owing us. So those customers that is owing the business organization, we call them what? Trade receivable. Please don't forget. Those customers that is owing the organization that we have made the sales to them, but they are yet to pay. We call them what? We call them trade receivable. So I cannot have a what? A ledger now. For what now? For buyer. Buyer account. And this is an asset account because buyer is what now? Buyer is owing us. So I'll have a what? Buyer account now. We have sold to buyer, but buyer is yet to pay. So debit and credit. Then I'll say what now? Sales of 1.5 million. So that is it. To buy. I'm selling to buyer now. You can see I'm not taking this 1.5. I'm not taking it to cash. I'm not taking it to what? To bank, because buyer has not what? Buyer has not paid. Buyer has not what? Buyer has not paid. So I'm going to create a what? A ledger now for what? For buyer. Which is a what? This buyer account is a what? Is a receivable account. Is a what? Is a receivable account. Because buyer is what? Buyer is owing us. Buyer is owing us. So that's it. Please, I hope you are getting that. So I can strike this out now. The next one. Let's say purchase goods on credit from Gubi PLC. So that means that we are also buying goods on what? On credit. From who? From Gubi. So we are buying from who now? We are buying from Gubi. So I'll say what now? GUBIO. What is the amount? The amount is what? Is 900. So I'll go to my purchase account and put what? 900. Now, the vendor that you are buying from now, we are here to pay that particular vendor. So I'm going to create that particular vendor now. I'm going to create that particular word. I'm going to create that particular vendor. So let me say what now? Gubi. And just like I made mention earlier, those individuals that the business organization is owing. You bought something from someone, you are yet to what? You are yet to pay. We call it what? Trade payable. We call it what? Payable. But those people that were, those customers that we sell to, but they are yet to pay us, we call them what? Receivable. Call them what? Trade receivable. So we are also buying from what? From Gobi now. And this is a what now? This is a liability account. Because we are owing this particular what? We are owing this particular vendor. So if your liability is increasing, what are you going to do? If your liability is increasing, if your liability is what now? Is increasing, you are going to credit. So I'm buying from this guy now on credit. So I'll say what now? Purchase. 900. Because I'm owing this particular vendor, we are here to pay. And that's why you can see this word number 6 now. We have paid. That's why I'm not having this particular vendor name. But here now, we can see I'm using the word, the name of the vendor, because we are here to what? We are here to pay. So we also have another terms. They say what? Cash sales banded. Cash sales was cash sales banded. Of how much? 1.5. Cash sales banded of what now? 1.5. Cash sales banded. So meaning that there's a what now? There's a sales of 1.5. And we take it to the words. We take it to the bank. So first of all, I have a sales of what now? 1.5. So I need to go to my sales account. We have sales account already, the sales ledger. So you don't need to create another one. So we just need to look for it. So this is sale. So we say what now? This is a cash of what? 1.5. Then we have a what? A cash account already. So you go to the cash account and say what now? You go to the cash and say what? Sales. A cash sales of 1.5. So I have recorded the word sales now. And that's it. A cash sales of 1.5. Sorry, we are almost through. The next one, let's say a purchase. We made a purchase of 500 cash, 1.5 bank. So we'll go again, our purchase account. We're also going to split it as well. There's a cash of what? 500. And there's also a bank of what? Of 1.5. We buy, but we pay different. We pay 500 by cash, and we also pay 1.5 million by what? By cash. Sorry, through the bank. So whether it's a what? Whether it's a credit sales, whether it's a what? Is a cash sales. So far that the word, so far that is a word, so far that is a sales, is going to be on the word. Sorry, so far that is a purchase, is going to be on the debit. Whether you have even paid or whether you have not what, whether you have not paid, it's going to be on the word. It's going to be on the debit side. It's going to be on the word. It's going to be on the debit side. So, but we have paid for this transaction. We pay 500 and we also pay what? 1.5 through the bank. So I will go to my cash account now. My cash is reducing, right? So I'll say what now? Purchase in my cash account of what now? 500. Because I purchase and I pay the cash of what? 500. Then I also purchase as well 1.5 million. I also paid 1.5 million, but that one is through my bank account. So I also need to go to the bank account now and put 1.5 on the credit side. So we have what now? Purchase. $1.5. So that's it. Don't worry, it may look somehow, but don't worry, it's a very simple thing. After the end of the class, just sit down and look at it again. It's not bad. Let's go to 14. Return goods to what? To Gobi PLC of 5,000. You return goods to what? And where is this Gobi? You can see on the 11, purchase goods worth what? 900 from who? 900,000 from Gobi. You are now returning to what? To Gobi now. You are returning to what now? You are returning to Gobi now. You are returning. Of 5. And sorry, this should be what? Yeah, this is 5,000. So, let me not tell you something. There are two types of return. We have two types of what? Of return. There are two types of return. There's what we call return inward. There are two types of what? There are two types of return. There are two types of what? There are two types of return. There's what we call return inward. There's what we call what? Return inward. There's what we call return inward. So let's go. There are two types of work. There are two types of return. There's what we call return inward. There are two types of return. There's what we call return inward, and there's also what we call what? Return outward. There are two types of word of return. There's what we call return inward, and there's also what we call return outward. So when we say return inward, we have return inward. That is one. And we also have another one called what? Return outward. So when we say what now? Return inward is from the customer back to the word to the entity. Return inward is from the word from the customer back to the word to the entity. That is, you sold to your customer and your customer returned. So if the return now is coming from your customer, return inward is from what? Is from the customer. Return outward now is to the what? Is to the suppliers. If you as an organization now, you sold a certain unit to your customer and your customer return it back to you and that, oh, this goods is what is damaged, then that is what we call what? Return inward. But if the organization now, you are returning back to your what? To your supplier. That is what we call what? Return what? Return. That's what we call return outward. Number two now, if the customer is returning back to the what? Back to the organization, that is what we call what? Return inward. Please don't forget. Return outward is that, oh, you buy from your supplier, you as the entity, then you return back. That is what we call return outward. Return outward is from the entity back to the vendor. The second one is now what we call return inward. Return inward is from your customer back to the what? To the entity. So if you look at this question now, they say return to what? To Gobi or 5,000. You have bought from this guy before. And this is it on the 11th of 900,000. You are now returning what now? 5,000 goes back to the what? To you. So this is what we call what now? Return outward. Because it's from you, the organization, back to your what? Back to your supplier. So we now need to create a ledger now called what? Return outward account. You need to create a ledger called what? Return outward account. So I'll have a what now? Return outward here. Because I don't have a ledger called return outward initially. That is why I am doing what now? That's why we are creating a what? A new one. Assuming that there's already an account, a ledger called return outward, there's no need. So you can see now, this is the Gobi. Now, let me now ask now, this, you can unmute yourself as well at this. Since we are returning back to this vendor now, is our liability reducing or is it increasing? Because we have not paid. That's why we are having this account payable. We have not paid this. So is it reducing or is increasing since we are returning?
It's reducing.
Is reducing. So if our liability is reducing, just like what you make mention, it's fine, it's reducing. Because I bought something of what? Of 900,000 from you. And I returned 5. So it means that my liability is what? Is reducing. So if your liability is what now? Is reducing, then what we need to do now is to what? We need to credit the account. Since our liability is what now? Is reducing, we need to credit the account. We need to debit the account. If our liability is reducing, we debit it. Liability is what? Is reducing. If our liability is reducing, you do what? You do debit. So I will say what now? Return outward. 5. Then you come here and say what now? For every debit, there must be what? A credit. 5 is already sitting out here. Then we say what now? Maybe from Gobi. So 5. So at the end of the day now, what I'm owing Gobi now is what? Is 895.
802.
Yes, 895. That is what we are owing this particular one. Because we are returning what now? We are returning 5 back. So please, this is what we call what? Return outward. And please don't forget, there are 2 types of return. Let me still explain it again. Oh, sorry, it's already time, but just give me like what's extra, like 10 minutes so that I can complete this question. So there are 2 types of return. There's return inward and there's also what? Return outward. Return inward is from the customer back to the organization. Return outward now is from the organization back to the supplier, back to your vendor. And that is the case that we have here now. So that's all. Then they say receive check from what? From buyer of 800. You know, Look at it, where is by yourself? Okay, look at 9. Goods sold on credit to buyer. There's it here. Goods sold to credit to buyer is how much now? You sold goods of how much? 1.5 to buyer. So buyer is now coming in now to pay. He paid by check of 800. So what buyer is owing us now? Is he reducing or is he increasing? Anybody? Buyer is owing us 1. And buyer has paid 800. So is he reducing?
Reducing as well.
Yeah. So now this is buyer account now. I've recorded it initially that I made a sales to buyer of 1.5. That buyer is owing me 1.5. And now buyer is what? Is paying by check. So I will say what now? Bank is paying 800. So we say this is an asset account, right? If asset account is reducing, what are you going to do? You are going to credit. If asset account is reducing, what are you going to do? Is what is credit. So I'm crediting now buyer account with 800. Then I'll take the money to my bank account. I think we have a bank account ledger already. And this is it. So, and I'll say what now? Buyer 800. For every debit, there must be a credit. If you go to buyer account now, you are going to see this 800 on the credit side. Is it? You can see. If you go to the bank account now, you are going to see it on the what? On the debit side. That's the principle. For every debit, there must be a what? A credit. For every debit, there must be credit. For every credit as well, there must be a debit. So, and that is what about. But buyer is still owing us, sure. The next one, we paid electricity of 120 by check. We paid electricity. So we don't have a ledger for electricity before. So we are going to create a new ledger now for what? We are going to create a new ledger for electricity. Electricity account. Credit. Then how do we pay? So we pay by what? We pay by check. So this is an expenses. I'll say what now? Bank 120. Then I'll now go to my bank. And I'll say what now? Electricity. $120. Since I'm paying by bank, and if your asset is reducing, bank is my asset. If it is reducing, is what is credit. So the electricity that we are paying now is reducing the balance that we have in our bank account. And that's all about that. Then, sorry, it remained few left. Purchase a power plant worth 4 million, making an initial payment of 2.5 million by check to Jacko Solution Nigeria Limited. So a power plant now. This is an asset. A power plant is an asset account. So, but I don't have a power plant account before. I don't have a power plant account before. So I need to open a power plant account. So we say power plant. Okay, so that's it. Now, this power plant is 4 million, right? It was 4 million. But we made a payment, initial payment of 2.5. and we are here to pay the remaining one. So I will say, well, we are going to split the transaction now. That, oh, we have made a payment. I will say what now? Bank 2.5. Then it's worth 4 million, but I have paid initial payment of 2.5. So it means that I'm left with what now? 1.5. So that 1.5 now is payable of what now? Of 1.5. Because we are owing that amount. We have not yet paid that particular amount. So I can go to my bank now and say what now? Power plant of what now? Of 2.5. Now, I have recorded that, I've done the debits. The next one now is that, okay, I'm still owing this particular vendor, Power Solution Nigeria Limited. I'm still owing them. So I'm going to create an account for what? For Power Solution Nigeria Limited now. This is a what? A liability account. I'm just writing it as an example. In the exam, there's no need of you doing something like this. We are owing what now? We are owing Power Solution. You can see 1.5 is here, Abby. Then we'll say what now? Corresponding entry will be on the what? 1,500. And we'll say for what? For power. For power. And someone was asking a question there. Look at this. Look at this now. And look at this particular question, number 6, on January 6th. They say bought delivery van of what? Of 3 million from this by pay by check, right? So you can see now, I didn't show the name of this particular vendor because we have paid. But here now, you can see I'm showing what now? Jaco Power Solution Nigeria Limited, because we are still owing this particular vendor. That is why we are creating a what now? There's a ledger for it. But if you look at the word, the previous one, for this delivery van, we didn't show the name of this particular vendor because we are not owing. So what we need to just do is what? Debit the delivery van account as an asset and credit our bank with 3 million. And that's all. So, and that is the end of this. The next one, they sold goods on credit to buyer 1 million. So we have a buyer account before. This is buyer. So I don't need to create a new ledger for it since the ledger is already in existence. So I'll go to my word. This is my sales, a credit sales. Sorry. This is what now? Buyer. Of how much? 1 million. Then we'll come here and say again, sales. Sorry, what is happening to me? To buy. And that's all. On the 21, received check from what? From buyer of 600 in full settlement of his what? Of his first purchase. So that means that on 21, buyer is what? Is paying because buyer is owing us initially. So we receive a check from buyer. So we say what now? Bank 660. Then we'll go to our bank account. Then we'll also say what now? Buyout. 660. We pay salary. We don't have a ledger for salary account before. So now we need to have a what now? We need to have a ledger for what? For salary. So we'll say what now? Salary. Salary account. And salary is a word. This is an expenses. Salary is what is an expenses. So these are salary ledger. Our credits. Then we also have our what? We also have our debit as well. So how do we pay that salary? I say we pay salary by cash. Salary by cash. I have record this of 540 by cash. Salary of 540. Then I'll say what now? By cash. So it's 540. Then we'll go to our what now? We'll go to our cash account. We already have a cash account before. Then we'll say what now? Salary. For every debit, there must be a what? A credit. Salary. 540. And that's just it. If you look at it, in cash account is on what side now? Credit. If you go to the salary account themselves, it's going to be on the what? It's going to be on the debit side. And that's what you can see. That is the principle. And the last one now, I'm sorry for taking a little bit of your time. It's just what now? Let's say we draw cash for personal use. That's what we call drawing. That is coming from the owner of the business. The owner is making a certain drawing. So we have an account called what? Drawing account. And this is also what? It's also an expenses account as well. So drawing. So how much was the drawing? The drawing was 160. So we'll say what now? Is it cash or a cash drawing? So you say cash 160. Then we'll go to the what? We go to the cash account. Go to the cash account and say what now? Drawing. We have what? Drawing now of what? Of 160. And that's all about what? And that's all about everything. That's all about everything. That's all about everything. And that's how we do it. That's how we record what accounting works. Don't worry, this is not the word. It's still going to be the same thing that we're going to be doing in what in the next class as well. So we are still going to work, we are still going to solve more questions on what on double entry. So that's the end of the posting, and that is it. So the next thing that this question is asking for is that what? Let's say prepare the ledger account for what and bring down the what? The balance. Bring down the word the balance. So what it means is that here I'm going to say what now? Balance carry down. Carry down means CD in accounting. So 540. You close the account. You close the account. Then we'll say what now? Balance. You're going to say what now? Balance brought down. That's what we call BD in accounting. So that's all. Then you also do the same thing for the remaining one. I have power plants. I will say what now? Balance carry down of what? Of 15. You underline it 2 times. Then you also bring it down and say what? Balance what? Balance brought down of what now? Of 15. Then you also have a drawing account. You also say balance CD. The balance CD is just the what the amount for the debit and the credit to be the same. It's just the amount that the debit and the credit need to be the same. So this is CD. I'll say what now? 16. close the account here too, and bring it down and say balance brought down of 160. Let me now do some now so that you're able to see the beauty. Okay, so look at this now. I have 900 on the credit side, and I also have 5 on the debit. These two accounts need to be the same. I need to have 900 here, and I also need to have 900 here too. So the balance is just the difference between, we're having 900 here. And the rule is that if you're having 900 as the total of this credit, you must also have 900 as the total of this debit as well. But I'm having 5 here. So for it to be the same now, what is going to be the balance that we are going to have? That's what we call the balance carried down. So I have my CT here. That is what now? 895, right? So then you also bring it down here and say 895. So that's it just. The two side, 900 here must be the same thing as 900 here. The total has to be the same. But we're having 900 here, but we're only having 5. So the difference is just what now? This 895. That's what we call the balance. And let me also do another one that has something like that. Delivery van, building. Okay, so let's do this bank account. So please, you are going to complete that at your leisure time. So what I need to do now, this is the last one, sorry. So I have what now? 18,000 plus what now? 800 plus what? 660. So that's 19,460. So I'll write 19,460. 19,460. This is an asset account. The debit will always be greater than the credit. This is an asset account. The debit will always be greater than the credit. So what we need to now do now, so that we're able to have 19,460, 19,460 on both sides. So we now need to say now that, okay, the first one, I have what, 8,000. So you had everything, 8,000 plus 3. Let me just be doing one after the other, plus 2, plus 15, plus 120. And we also have what, 2,500. So that's 17,120 that we are having on the credit side. And we're having what, 19,460 on the debit. So the two sides need to be the same. So you're not going to say what now? Minus 19,460. So meaning that I have to have 2,340 here for it to be for it to be the same. And at the end of the day as well, you bring it down and say balance brought down of 2,340. So meaning that what now? Our bank, we should be able to have 2,340. We should be able to have 2,340. So, and sometimes you may not able to have that because that will be another topic. We are still going to talk about bank reconciliation statements. So that's just it. Please try as much as possible to complete the words. You can just complete the rest as well. This is balance CD. There's nothing here. So 8,000. So it's still going to be 8,000. Then you bring it down. Balance brought down of 8,000. This side, there's not anything on the delivery. So you still say that, but balance was 3,000. Then you close the accounts. You close the accounts again. And then you say balance brought down of 3,000. Okay, so that's just it. So I'll send the work file, the remaining other one, so you can just balance the rest like that. So thank you, everyone. I'm sorry for taking a few minutes of the time. We'll continue in what's in the previous section. So thank you. And please, before we go, is there any questions so far? And here too, there's nothing here. If you have any questions, please, you can unmute yourself. So this is balance CD of, I think this is 20 million. Then you also bring it here and see what balance brought down of work of 20 million. So that's how it works. That's how it will go. So thank you, everyone. I'll send the work file. So in case if you want to update anything, you can just do that.
Thank you so much.
So thank you, everyone.
Just needs more reading so we can
Yeah.
make it clearer. Thank you. I appreciate it.
Thanks. So thank you, everyone. And bye for now. I'll send the work file so you can update at any time.